Welcome back to Investing Talk Podcast.
Today we're looking at Rezolve AI.
As usual, before we start, subscribe, like, and comment to this video to support the show, and if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Okay, so let's just dive right in. When you look at the financials, specifically for the full year 2024, the first thing that really jumps out is just the speed of the business.
The acceleration, yeah. They hit $16.3 million in revenue. That's a 52% increase year over year.
And wasn't just meeting expectations, right? They actually beat the analyst consensus.
They did. But, you and I both know that for a growth stock, especially in AI, just growing the top line isn't enough. You have to look at the quality of that revenue.
Of course.
And this is where the story gets, I think, really compelling. Their gross margin expanded in a big way. It jumped to 74.1% in fiscal 24.
Wow, from what?
It was up from 68.3% the year before.
A 6-point jump in gross margin in 1 year.
Yeah.
While you're scaling that fast.
Yeah.
That's staggering. How did they pull that off?
Well, it really comes down to two major operational wins. First, they finished a really big migration. They moved their legacy clients onto a new cloud-native AI engine.
Okay, so a tech upgrade.
Right, but it was more than that. It was a cost-cutting move. It directly lowered their hosting costs by 32%. That's a huge saving.
And that kind of transition can be really risky. Seeing it pay off in the margins so quickly suggests, pretty flawless execution. What was the second piece?
The second part was all about labor and efficiency. They started using AI chatbots to automate the whole customer onboarding process.
So they automated the bottleneck.
Exactly. This cut their implementation labor costs by an estimated $1.9 million a year. So you've got cheaper hosting and automated labor. That's how their model is scaling so efficiently.
That is the definition of operational leverage kicking in. But, while margins are great, the thing that really changes the risk profile for a company like this is free cash flow.
This is the metric. This is the one everyone needs to see. After burning cash for years, their free cash flow actually turned positive in Q3 of 2024.
And what about Q4?
In Q4, they hit $1.1 million. This is the first full quarter of positive FCF in their entire history as a company.
That's a game changer. It means they're self-sustaining. They don't need to go to the market for cash to fund their day-to-day.
Precisely. And if that wasn't a strong enough signal, you just have to look at their forward guidance.
Yeah.
It's incredibly aggressive.
Yeah, I saw the EPS revision for 2025. It tightened up from a loss of, negative 2.18 to about negative 2.66?
Right. But the market isn't really focused on past earnings. It's all about the future annual recurring revenue, the ARR.
And those targets are something else.
They are. They raised their 2025 ARR guidance to over $200 million. And then they reaffirmed the 2026 target at $500 million.
Let's just put that in perspective. This is a company that just hit $16 million now trying to hit $500 million in ARR in 2 years.
There you go.
That's bold.
It is, which is why they also had to put a timeline on profitability.
And what are they saying there?
They're now projecting positive adjusted EBITDA by December of 2025. It all lines up with that aggressive revenue ramp. It's not just a growth story. It's a very clear path to profitability story.
Okay, so that leads to the obvious question. How?
No.
How on earth do they plan to execute on that? It looks like they have two different competitive modes, one for the UK and one for the US.
Exactly. Two very distinct technologies. Moat number one is their UK public sector business, and it's built on their proprietary multimodal AI orchestration layer for procurement.
Okay, that is a mouthful. In plain English, what does that actually do?
Think of it like this. It automates the whole buying and paying process, that procure-to-pay cycle, without needing any custom code.
Which is a big deal because competitors like UiPath or Automation Anywhere often need these long, expensive consulting projects to get set up.
That is exactly right. So their moat isn't just about having better AI, it's about frictionless deployment. The source material shows their average onboarding time is just 18 days.
60% faster than the competition?
Yep.
For a government agency that wants to save money now, that's a huge selling point.
It's a critical differentiator. Now, that's their B2B focus, but then you have this totally different thing happening in the U.S. market, what they call agentic commerce.
Right, moat number two. So this is more consumer-facing.
Yes. Agentic AI is kind of the next step in customer engagement. The AI doesn't just chat with you, it actually goes and completes the purchase for you. It moves from advice to action.
Like a smart digital agent, they can actually execute tasks.
Exactly. And they've gotten incredible validation here. They have exclusive partnerships with huge tech firms, Microsoft and Google, to process transactions.
And the volume.
The platform is already processing over $1 billion in digital asset transactions. That shows you how trusted and capable their tech is.
The partnerships seem key to both modes, but maybe even more so on the UK side with the government contracts.
Oh, absolutely. They have exclusivity agreements with 7 UK regional procurement hubs. That's basically a protected pipeline that competitors can't touch.
And they're embedding themselves even deeper, right, with that Pulse Systems partnership.
Yeah, that partnership embeds their AI tools into over 450 local government entities. When you combine that exclusivity with deep software integration, you create these massive switching costs.
And that's the stickiness factor.
Yeah.
If a client is using Rezolve AI to manage a dozen other legacy systems, SAP, Oracle, you name it, ripping it out becomes almost unthinkable.
It becomes the connective tissue. It's not just another piece of software, it's the central hub. And that makes the ARR much more durable.
Okay, so the fundamentals look strong, the moat seems solid. Are the technicals, the charts confirming this story?
The charts are definitely looking constructive. We saw a golden cross confirmed back in January of 2025.
And for anyone who doesn't follow the charts, what does a golden cross signal?
It's when the short-term trend line, the 50-day moving average, crosses up and over the long-term 200-day moving average. It's a classic sign that the long-term trend has turned bullish.
And there's a visual pattern forming as well, isn't there?
That's right. A very clear bullish cup and handle pattern has been forming since last October. We saw a confirmed breakout at the £1.35 level.
On high volume.
On 3.2 times the average volume. High volume on a breakout like that gives it a lot of credibility.
So based on that pattern, what's the potential upside?
The projection gives a target range of about £1.85 to £2 sound. So that suggests, anywhere from a 15% to 40% upside from recent levels.
And it's not just chart watchers getting in. We're seeing real institutional money flowing in.
The institutional confidence is pretty clear. Ownership jumped from around 29% to almost 39% in just the fourth quarter of 2024.
And these are serious players.
Very serious. Firms like Cormorant Asset Management, Cohen and Steers, they're either adding or starting big positions. That's a signal that deep due diligence has been done.
Plus, you've got one of the strongest signals of all insider buying.
Yes. The CEO bought 250,000 shares back in February at about £1.08. This was the largest insider purchase since the IPO. When the person who knows the most puts that much of their own money in, it speaks volumes.
Okay, so fundamentals accelerating, technicals are green, institutional money is moving. Let's look at the calendar. What catalysts are coming up?
The most immediate focus is the Q1 2025 earnings release on May 15th. That's the next big test.
What are people looking for?
Analysts want to see revenue between 3.3 and 3.5 million pounds. But really, the market's going to be watching two things. Gross margins staying above 58% and ARR growth above 15% year over year.
And there might be an investor day around that time, too.
Possibly. A day before earnings on May 14th in London. The idea would be to show off the EU expansion plans for France and Germany and maybe demo the new Auto Procure 3.0 product.
But the biggest catalyst of all seems to be a regulatory one.
That's the one. The UK Procurement Act 2025 compliance deadline is coming in late June. If Rezolve AI gets official AI-ready status, well, that's a potential game changer.
Because it could basically mandate their use across the public sector.
It could create a massive surge in demand overnight. It's the kind of thing that could actually make that $500 million ARR target seem achievable.
Of course, that timing is a risk. A delay there could really hurt sentiment.
It's a huge risk. If that certification gets pushed back, or if they go quiet in June and July, investors could get nervous pretty fast.
And then there are the check-ins later in the year.
Right, a fireside chat in December, a growth conference. Those are the moments where they have to prove they are on track for those huge year-end goals.
We've laid out a pretty strong bull case here, but we have to talk about the risks. And Rezolve AI has definitely had its share of problems.
We do. And the biggest one is the shadow of that short seller report from Fuzzy Panda. It was brutal. It alleged revenue overstatement, AI misrepresentation.
And that led to class action probes and a big drop in the stock price. That history doesn't just disappear.
No, that pressure is still lingering. And even with the positive FCF in Q4, you can't ignore the legacy baggage on the balance sheet.
Right, they still have negative equity existing debt.
And a trailing EPS that's still negative at over $1. The forward story is great, but you have to trust management to navigate that historical fragility.
What about structural risks, like client concentration?
That's definitely a factor. The top 5 clients make up 43% of revenue. That is high.
But there are mitigating factors here.
There are. All 5 are public sector entities, so they're stable. The contracts are long-term, averaging 3.7 years, and the retention rate is reportedly 92%. So the risk of a sudden loss is lower than it looks.
And finally, that regulatory risk we mentioned. If that UK certification gets delayed,
Then the whole EU expansion timeline could slip, which would put the 2026 guidance in jeopardy. It's a classic execution risk.
but you could argue a lot of this is already priced in. The stock is way off its old highs.
I think that's fair. The valuation suggests the market is well aware of the short seller report, the debt, the potential delays. The momentum they have now provides a pretty strong counter-argument.
So when you put it all together for someone tracking this, you have this clear financial turnaround on one hand.
Expanding margins, positive cash flow, 2 really solid moats.
But on the other, you have the short seller history and this huge bet on hitting some very aggressive targets and regulatory timelines.
That's the central conflict here. It's a high-growth SaaS story bolted onto a slow-moving defensive regulatory moat. Can they run a sprint and a marathon at the same time? That tension is where both the opportunity and the risk really live.
So that May 15th earnings report becomes a critical checkpoint. It's going to either validate the bull case or give a lot of ammunition to the skeptics.
You'll want to keep a very close eye on those gross margins and see how the company continues to address that lingering short seller narrative. If you found this analysis valuable, make sure you subscribe. We'll be tracking all the catalysts as they unfold right here.